Good afternoon, everybody, and welcome. This is our third BTR borrowers and lenders discussion, kindly hosted, as always, by UKAA. Today's speakers are Shah from Lloyds Bank, who's going to be speaking to some of the COVID-related government support programs that are getting a lot of attention right now. We have Bladon from Investec, who will be sharing his insights from the development lending standpoint, and we're also joined by Andrew Hornblower from JLL, who will be providing his perspective from the advisory side. Sam, I'm going to pick on you first, if that's okay. I'm curious to know, how's your life changed in the last 3 plus months? I imagine much of the bank's bandwidth is taken up performing triage to the existing book or managing these government COVID lending schemes. I read this morning actually that OBR forecast total bill for these support measures to stand at 123 billion when all is said and done. So I guess the question is, how's that affecting the day job, and does it mean just less capacity to originate and quote new real estate loans going forward?
Yeah, thanks. Good afternoon, everyone. Yeah, absolutely no surprises. As with most lenders, we've been the focus has been really on supporting clients through a variety of measures and instruments through these unprecedented times. And one of those instruments or series of instruments has been the government schemes, which were announced within a couple of days, if not a week, of lockdown. And there are principally I think they're well advertised. There are 4 or 5. C-bills, as many would have heard, and then the sister of C-bills or the brother of C-bills, which is the CL bills, the corporate finance facility, and then the bounce back loan schemes. Those are kind of the broad categories. And yeah, the real challenge for us was these schemes were built on the back of existing infrastructure, the enterprise guarantee schemes, and so within the kind of original or historic IT infrastructure and architecture. And so there was a real effort, I think, not just with us, but every lender to really fine tune those systems, given the volume and just sheer amounts of activity and requests. And of course, it was somewhat of an iterative process because, as I said, it was based on the enterprise guarantee scheme, which had certain sectoral exclusions. And I think really from a real estate perspective, we found that, once there was the clarity from the British Business Bank that real estate would form part of that sector, then really things sort of gathered pace. Now, my personal experience has been very much on the CL bills front, which is really the difference between C bills and CL bills is the turnover, primarily. If you are a group or a business that has greater than 45 million turnover, then you typically fit into CL bills. Less than that, you're into the C bills. And I guess the principal difference really in terms of the shape of the schemes is, C bills is 5 million of support, up to 5 million of support. You've got a 12-month interest free period, which is covered by the government. And then CL bills, it could be up to 200 million and a slightly longer repayment term. To be honest, effort has been across all schemes, including the corporate finance facility. But if I just specifically maybe point out a couple of things that that we've experienced, and all of these things have to really be looked at on a case-by-case basis, particularly given each borrower's circumstances, corporate structure, etc., very, very unique. But one thing that we found going through these schemes within the real estate spectrum is that the group classification isn't always straightforward. I mean, most real estate groups, as you know, Jonathan, it's not just one entity. You can have multiple SPVs underneath, multiple joint ventures. And that sometimes means that you've got to really, work with the counterparty to assess whether, you're looking at just that SPV or whether actually there's a wider group that needs to be looked at. And that has meant that, some requests which we originally thought would fall under C bills have actually landed in the CL bills territory, because when you aggregate all the JVs across a group or the various SPVs, that means that turnover that jumps above that hurdle. I think the other interesting point just to mention is that whilst there's an absolute recognition that these are schemes really there to assist in the immediate liquidity, to try and bring businesses back to health. The credit policy parameters are very much that, the lending product has to be within the existing credit policy framework. And what I mean by that in simple terms is, principally Lloyds, we provide senior debt. We don't really do mezzanine or stretch senior. And so that's been something that on certain situations has meant that, look, it may not be viable for us to proceed because this is sort of slightly outside our sort of traditional credit appetite. And then there's been, particularly on the CLs bill front, what I've already noticed is that if something is classified as a financing vehicle, then and we can I'm happy to share after this call or go into the depths of that. But if something is a financing vehicle, which is most SPVs, which don't have employees, that don't have sort of regular operating turnover, then you've got to kind of assess it in the context of a wider group. And I think what that means really for real estate and developers and investors is that you've got to ensure that the CL bills advance has to share in 90% of the collateral that's been pledged across that group. Now, you can imagine that if you've got 3 or 4, 5, 6 SPVs, each with different lenders, as is often the case in the kind of lending that we do, that presents a bit of a challenge. And maybe finally, I personally deal with a lot of private equity funds and institutional sponsors and listed sponsors and developers. And one of the bits that has particularly caused a little bit of an issue has been sort of this undertaking in difficulty, where funds are required to sort of prove that pre-COVID they're able to give an undertaking that they weren't in difficulty, and that's got a variety of tests. Requires you to go and delve in at the fund level. And of course, a lot of funds don't provide a consolidated view. It's equity accounting. So look, on the whole, I would say, actually it's been a humongous effort on the part of lenders. I think in C-bills, there are 50 accredited lenders now, huge efforts from the BBB. And whilst, you might hear a few things here and there in the media, I really do think people have come together to sort of advance these loans. And I think that probably to end on that, this is not the only tool available to us. I think what we've really seen actually during this whole period has been the kind of the lender toolkit is actually pretty vast. I mean, we've put through a lot of covenant waivers, given flexibility as far as operational lease amendments and milestones. We've also extended facilities, refinanced facilities, and indeed re-geared facilities. So I think there's a whole host of measures available, and kind of lender balance sheet support is still on the whole very much available, certainly from Lloyds. So yeah, a mixed bag in terms of the responses depending on the situation.
Okay, wow, thanks, Sam. That's comprehensive. Appreciate that. Andrew, I'm quite keen to hear from you from the advisory standpoint, because obviously you're across the whole market and speaking to multiple lenders every week. What's the general mood music like from that community, and how much delta are you seeing now between, say, UK deposit banks, debt funds, investment banks, and fan brief lenders?
Sure. Well, there's a lot there to unpack, but I guess I would start with, we're really seeing a different narrative depending on which type of lender you're approaching. For the UK banks, groups like Lloyds, as Sam mentioned, they really have had their hands full with these government programs and their existing loan book. And that's been the primary focus rather than originating new business. There are some interesting currency dynamics which are at play here, which impact primarily the US insurance companies and banks, and also the European lenders. So what we've seen is US insurance companies and banks were previously benefiting from a significant currency hedge pickup because of the rate differential and the risk-free rates between the US and the UK. But because the risk-free rates in the US have dropped by so much, those lenders have lost a material advantage, which was over 100 basis points in gross interest return. So that, in effect, has essentially turned their attention more toward US opportunities. And the exact opposite has occurred with many of the European lenders. So German banks, European insurance companies, they still have a disadvantage, but not as big of friction costs as what they were fighting pre-COVID, just because the UK indices have dropped. So because of that, we're actually getting inbound requests from groups like Allianz, groups like Generali, who have euro-denominated capital that previously was less competitive in the UK, but is more competitive now. So broadly, lender sentiment is definitely better than it was a month ago, and that's across sectors. There's a few sectors which are still lagging. I'd say retail and hospitality being the primary two, followed by care homes, and then I'd also add student accommodation in there as well. Just property sectors where there's some bigger structural questions. But aside from that, so build to rent, office and logistics, I'd say lender sentiment is overall not quite back to where it was pre-COVID, but definitely getting there.
Okay, great. That's good to hear. And actually quite a neat segue into my question for Mark. So Mark, you guys are obviously a business that's, you're pretty long or focused on the living sector. So PBSA, BTR and retirement living. I'm interested to know how these asset classes are perceived differently by the bank at this time, if indeed they are. I'm thinking specifically with regard to PBSA, developments that might be approaching that September window that are now potentially going to miss that due to construction delays, or up and built operational PBSA schemes that might be anticipating, not receiving overseas students if they fail to show up this September.
Yeah, as you say, we've got quite a large exposure to PBSA at those different stages. Schemes that are PC this September, some next September, and some that are trading. I suppose on the development side first, the ones that are PCing next year, we're obviously less worried about because there's still an amount of time for clients to reprogram the bill contract. There are various sort of catch-up measures you can do to accelerate build and to still deliver on time. I think the other thing that was quite interesting for us as we went into the sort of lockdown is how sort of sites closed down and how clients sort of adapted to it. So, for example, we've got a number of sites in Scotland where the sites were just completely closed, and I think they still are closed. Whereas in England, it was quite different. We had some sites that didn't close at all. We had some sites that closed for a week or two and then reopened. And I would say most of them are operating now probably somewhere around the sort of 50 to 70% of capacity. The other thing that influences them is at what stage of the development you are. So schemes that are PCing this September, it's much harder because they're in the sort of fit out stage, and it's much harder to maintain the sort of social distancing requirements. Stuff that's PCing the year in 2021, where you're still outside, you're piling, pouring concrete and so on. Those guys haven't lost as much ground. I think, how we and our clients approaching schemes that are going to PC this September is first, staying as close as we can to the information being provided by the relevant universities as to what their opening plans are. That's different per university, per town. But I think most of them are looking to open in some shape or form. But again, that can be anything for opening as normal to currently being online, or where we see the majority, which is some sort of blend in between. I still think we're about a month, maybe 2 months away from getting more real clarity on how they're going to open and what date. But what we anticipate is that by January, sort of latest, most universities will be open and operating in a normal fashion. And that may lead to either a delayed opening, which would give us time and our clients time that are developing to be able to catch up and PC for a delayed start in the term. It may be that so a lot of the conversation at the moment is what appetite do international students have to come over for PBSA, and actually what capability do they have to come over and quarantine and still meet deadlines and so on. And one sort of scenario one of our clients is sort of anticipating is perhaps first semester this year of online for students, for internationals, and then still signing up for the full course, but coming over to the UK in January when things are a bit more sort of back to normal. In terms of assets that we've got, that we're lending on that are already trading, again, a very mixed bag between some that are anywhere. We've got some schemes that are 30% occupied at the moment, and some that are 60% occupied. And again, our clients take different different approaches as to whether they've decided to waive the final semester fees, or whether they're going to change them, because in most cases the students will still be obligated to pay whether they're in situ or not. So, you know, there's a lot of sort of management issues going on there. And at the same time, you're trying to sort of let for September, or, you know, for the 2021 academic year. But I would sort of just finish off saying on that particular sector, though, is what we're seeing across our probably sort of 10, 12 assets that we're involved in, and it's reflected in the wider market, is lettings for the next next academic year are actually slightly up on previous years. So whilst that may change and a delayed opening of universities may seem some fall off, as we stand here with all the information that we have, we're seeing quite strong lettings across that sector.
That's interesting, quite reassuring, I'm sure, to many of our listeners who won't just be in BTR, but also PBSA. Okay, let's move gears then. Let's talk about rates and margins, because I think that's probably what everyone wants to know going forward. Is it just too simplistic to say that COVID has universally increased, you know, has kind of, you know, increased margins and reduced LTVs, or is it a bit more nuanced than that? You know, I'm wondering, to what extent does the sponsor-lender relationship cut through the kind of COVID noise? And to the extent that, you know, in collection rate terms, at least, BTR seems to be performing well, at least compared to our other asset classes. So what's the kind of the house or houses view on lending terms going forward for BTR?
Well, certainly from what I've seen, Jonathan, I'll take the lead here, but I'm sure Jonathan and Mark will chip in. Look, I think we've been in a risk-off, you know, generally in a risk-off environment for the last 3 months, where people have been taking a bit of a pause, assessing what some of the longer-term structural impacts may be. I think, you know, in some ways, liquidity and pricing, or LTVs and pricing is in essence driven in part by liquidity. And I think there have been fewer participating lenders, and I'm sure Andrew can, you know, give you a bit more of a flavor on that. But from our perspective, I think LTVs on the whole, and whether that's LTC/B, depending on what we're looking at, on the whole, I think there has been a slight tapering between 5 and 10%, I would say. But again, I think it is somewhat horses for courses, because it depends on, you know, the specifics to that particular borrower, sponsor, and the asset. And obviously there are some assets which will fare slightly better or slightly more prime, or have slightly different characteristics, which mean that, you know, perhaps lenders can be slightly more aggressive there. But on the whole, look, in this environment, obviously the scrutiny from credit committees and investment committees is perhaps, you know, dialed up a bit. And so what we've seen is actually a, you know, willingness to look at new proposals, albeit systems are a little bit slow, you know, grappling with existing situations, as well as, you know, the coronavirus business schemes. We found that, well, you know, we're open for business. It perhaps takes a little bit longer to get there, and we have been issuing term sheets and have been active. But yeah, leverage has probably tapered by 5 to 10%. I think margins have on the whole also been higher. And you'll hear all sorts of stories. I know Andrew and I have talked about some, but, you know, margins have been anywhere between 50 and 100 basis points higher from what I've seen. And actually, you know, some of that's been partially offset by the lower index costs, which is actually, you know, which has actually helped borrowers in some instances. And so what we've seen is borrowers entering into pre-hedges to lock in the benefit, you know, of the currently kind of, you know, depressed rates. And even, you know, in some instances, hedging beyond the term of the loan, albeit subject to some mutual breaks. Only other thing I would say is, for me, I think 3 years has sort of been the new 5 years. And I think that's driven both by borrowers as well as lenders. So, you know, some want to capture the sort of, you know, opportunity that you might have, a window. And certainly, as I said, I think there's some green shoots that are appearing right now. High yield debt market seems to be functioning, previously yielding 12%, now yielding 6%, has seen a, you know, billions of inflow. So it looks like things are picking up. And I think, you know, some borrowers obviously opportunistically looking at saying, I want to secure the financing so that I've got certainty, but perhaps not lock it in for the durations that we would perhaps previously have seen. And so certainly I've seen a lot more 3-year requests, or we've been progressing a lot more 3-year proposals than the typical 5-year proposals. So yeah, that's.
You mentioned pause and liquidity there. I guess if traditional balance sheet lenders such as yourself are taking a pause to either a greater or lesser extent, I'm wondering, does that provide opportunity for challenger banks and the higher temperature debt and mezzanine funds in the BTR space? And if so, how that changed the landscape for sponsors going forward? Maybe that one for you, Andrew, probably quite well placed to comment on that.
Sure. Well, I definitely would say there's an opening for those forms of alternative lenders, but they're facing similar challenges with their existing portfolios, and their cost of capital in many cases has increased as well. We really think of there being 3 main variables that influence the overall pricing that lenders push for. The first is their actual cost of capital. So for these debt funds, that can mean they have less efficient loan-on-loan facilities or warehouse lines, maybe higher pricing for those or lower advance rates. There's their actual risk assessment of the opportunity. So that variable is magnified in property sectors that have been more impacted by the crisis. Build to rent would be on the less impacted end of that spectrum, but still questions around go forward collections and operational risk. And then the last is what the lender thinks they can charge while still winning the deal, right? Because they're in the business of making profit on their loans. So all 3 of those variables are assessed together. And I think build to rent, because of all the different property sectors, is perceived to be one of the more resilient ones. You're going to see less widening than other opportunities in asset classes. But I agree with Sam. We've seen for most of the lower cost groups, 50 to 100 basis points of wider margins, which has been offset by, depending on the duration of the index, anywhere from 30 to 50 basis points in risk-free rates. So net, in the best case scenarios, you're pretty much net neutral versus pre-COVID. And then in worst case scenarios, usually about 50 bips wider on all-in interest rate. The alternative lenders have gapped out more. And that's partly just because their all-in return targets are higher. So for them to make those reasonable adjustments, the effect on the interest rate needs to be more. So we've seen debt funds reprice 100 to 200 basis points with maybe less sensitivity on lowering leverage, but still 5% in most cases. Rare examples of 10, really deal specific, but we are seeing that.
What about specifically construction financing? So kind of, rates and leverage aside, how's lending, have the banks tightened up the lending criteria? So I'm thinking specifically like cost overrun guarantees and interest shortfall guarantees. Maybe one for you, Mark, 'cause you guys pretty long on development finance historically.
Yeah, and what sort of surprised me is whilst the sort of lockdown feels like forever, and we're sort of in our 12th week now, how things have changed have been actually really quite rapid. We went into this, as I say, 12 weeks ago in an environment where sites were being closed, offices were being closed, same with pubs, restaurants, all this sort of thing. So you couldn't give finance, because if somebody said to me, I want to do a development, it was like, well, how are you going to get a build contract, and how are you going to get on site, and how are you going to meet this? So that sort of pause. That, as I said earlier, that's now sort of loosened up quite a lot now, and a number of existing developments are being reprogrammed, and we have more confidence in people coming to us with fresh deals. I suppose I agree with Andrew and Sam. I think in the same in development, leverage has come in sort of 5%, I would say. So previous you were at 60, 65, it's probably now 55, 60%. Yes, there's more focus on cost overrun guarantees. I think margins have gone up about 1%, and maybe fees 1 to 150. Certainly for our case, our cost of funding has gone up, and we have to sort of reflect that. The other thing you have to sort of take into consideration more on the construction side is we thought we did quite deep due diligence before, but now you've got to start looking at supply chains. You've got to really dig into maybe the subcontractors, liquidity and how financially solvent they are, as well as your sort of main contractor, and you've got to build in more sensitivity. So a bigger contingency, building maybe an extra sort of 3, 6, 9 months on the build program or sales program. So and the other guys, I don't think construction has moved massively differently to say other types of funding in terms of leverage and pricing, but it's more the structuring around it that we've had to sort of be a bit more cautious on.
Okay.
I think I add that if
sorry,
you think,
go ahead.
yeah, just very quickly, if you just take a step back as to what most lenders are facing, right, in this environment, without sort of, obviously each story is slightly specific, but the net interest margins, that's the bread and butter of most banks that are not involved in huge amounts of advisory work. It continues to compress, right? It has been compressing, and the low yield and the low interest rate environment, yield curve flattening, only worsens that. Now, and then of course you've got potential stress on some of the back book, which may or may not result in impairments, provisions, depending on the state of the economy. So with that backdrop, I think actually construction financing, whilst slightly higher on the risk curve, actually from a yield perspective, gives banks a nice avenue to basically get higher yielding debt out of the door. And I think that's going to be an interesting dynamic. Of course, the risk element does come in, and you could say, is pricing always truly reflective of risk? And that's perhaps one for a different session. But my sense is that I think it'll continue to be attractive as banks, particularly as you come into Q3, Q4. I think a lot of lenders will be under pressure to kind of allocate capital a lot more efficiently, because you're not going to be, in my view, you're not going to see a massive sort of floodgates. There are some participants that have left. They probably will be on the periphery for a while. Certainly with banks like us, it's very much a through the cycle approach for us. We want, and I'm sure is for Investec as well, we want to be there for our core clients through this. We are being a bit more selective, but I suspect the pressure will be on to absolutely originate new business. And I think construction financing is higher yielding.
Yeah. Okay. Let's talk about distress, the D word. Do you guys anticipate any BTR, specifically BTR loan impairment, ultimately leading to NPL sales, or is the sector just too defensive, too resilient, too well capitalized, too kind of lowly geared for any kind of meaningful distress to manifest itself, at least at this point in the cycle?
I could have a stab at that one. I think, I was talking to a friend of mine recently at JLO, and he was sort of telling me that, collection rates on the build to rent was in the sort of mid to late sort of 90s versus sort of 70% for commercial property. Yep. I think what sort of drives a lot of these, these are big scale schemes when you're doing 200 to 500 units or whatever in a project. And I think as an institution, if you're looking at where you want to put your money, you're going to want to put it where you think you've got a very diverse sort of tenant base, and that's very sticky. And because it's people's homes, they're always, it's going to be the last thing that they don't pay. So I expect, build to rent to be a lot more sort of resilient going forward. But I do think it's going to maybe impact on people and developers, maybe the design, the amenities. I do think in general, this COVID crisis is going to make people think more about where they want to live and, what it's like if you're sort of forced to live at home. So I think, things like co-living where you've got 14 square meter, beds or whatever, but you've sort of you've got that room because you feel that you're not going to spend much time there because you're young and you're doing long hours or you're out partying. I think if you then suddenly face 12 weeks of being locked in there, you're going to rethink. Whereas I think it is a good opportunity for build to rent where you've got a mix of flats where it's, unit sizes, more, say, outdoor amenity space that you can use. I think that will appeal to people.
You mentioned co-living there, which is something I want to touch on briefly. Obviously, that was a sector that was really only just kind of getting out of the blocks pre-COVID. To what extent does that business model now look under increased pressure, given its emphasis on, close personal contact and social interaction between residents? So I'm thinking specifically with regard to, the financing of that sector going forward.
I mean, we looked at a scheme just before the lockdown sort of started, which as a collective team we couldn't really get comfortable with, and I'm sort of glad we didn't really. I'm personally struggling to see it gaining sort of momentum it had previously. I do think, you know, I always thought it was the sort of in-between stage for residents between student and build-to-rent. And, you know, we're funding a scheme where it is a combination of PBSA and co-living, separate buildings, but the same scheme, the same sort of location. And that was partly because we saw an opportunity perhaps for students as they were graduating, but wanted to stay in that part of town, maybe get a job, you know, moving into a sort of product they were familiar with. But I personally think it's going to struggle in the near term. Maybe in the medium to long term, it will sort of come back, but in the near term, I think people can think carefully about it.
Andrew, what are you seeing? Are you seeing lenders pump the co-living brakes right now because of this, or you think it's game on, risk on going forward?
Well, the biggest questions we're getting are around alternative use, and if it is possible to relatively efficiently convert the use to PBSA and what the demand drivers might look like. And we've seen in a few examples now where maybe only a portion of the scheme is co-living, as Mark was mentioning, or maybe it's a very sensible and straightforward conversion to traditional PBSA. That's getting similar amounts of traction, but if it's a pure co-living business plan where there's not really an alternative use story, the general response is, why make this bet now when there's all the other opportunities we have in different sectors where there aren't the same structural questions?
Right, yeah, makes sense. Sam, question for you. Is it the case that banks are putting increased capital aside to cover off against forthcoming or potential forthcoming defaults? I'm thinking obviously things like retail potentially. And my understanding is that borrowers are drawing down on credit lines in unanticipated volumes. Is that going to constrain new lending going forward? Or is it simply just the case there'll be less credit going forward as we emerge through the crisis?
Yeah, look, I think, I think the first point to make is that certainly for us slotted lenders, I think appetite has always been somewhat selective, right? So we've not post GFC seen 75, 80, 90% LTV or LTC loans, not in the senior space anyway. So I think that gives us a degree of cover. No doubt though that you mentioned some sectors, and we've seen the retail sector, of course, particularly badly hit. And I'm sure that there will be some situations that face particular stress and will lead to impairments provisions. On the whole, though, I think that the vast majority of the banking sector is much better capitalized, and therefore my personal view is that there is sufficient, that there's enough headroom there to kind of withstand immediate stress. It shouldn't necessarily have an immediate impact. That said, of course, it's not just commercial real estate. I mean, the GFCs, the commercial real estate sector was the big one here. I think one of the interesting things about COVID is it's not as if it's not touched any element of life. It's touched every single type of industry, business, household. So the kind of collective impact of that, I think, is very hard to assess today. And for sure, we will see some businesses that no matter how much support that there is from the government or indeed from banks will inevitably fail. That's just the law of probability. So my sense is that yes, of course, if lenders are hard hit on some situations, have to take big provisions, that will curtail their ability. But by and large, I suspect that the decisions or the kind of originating activity will really focus going forward on backing your trusted clients and your trusted sponsors. Those that you've been able to work consensually with, as it was very much the case, I think, in the GFC. And I think the focus actually becomes on bang for buck. I think for most lenders like ourselves, it's sort of where can we meaningfully play our part? And I think build to rent is one of those areas. And sort of, still kind of provide support that is viable from a kind of credit structuring perspective for the client, but meets our internal return hurdles and risk appetite. And I think that the conversation for us is definitely going to be shifting towards, being, one that is really driven by that return risk kind of, sweet spot, I guess. But I still see origination happening. I don't think that, some losses in the near term will curtail that.
reassuring to hear, I'm sure.
A comment on that, please. I think it's quite interesting, you know, and I can sort of draw on our own experience of the last sort of financial crisis. You know, where I would expect to see distress and problems coming out is where sort of perhaps debt funds have leveraged quite highly for undercapitalized borrowers. So if you're lending someone 65 to 70% of value, certainly on a development deal, it's likely you're anywhere between 85 and 95% of cost. So the client's got not much capital in there to start with. And if that borrower is willing to pay anywhere between, say, 8, 10, 12% for that debt, it's because they've got nowhere else to go and they can't put more money in. And this isn't a criticism of the business model. It's from our own personal experience where we were very much in that market leading up to 06, 07. That's when you get the keys handed back to you. Sometimes the borrower will work with you and add value, but they just don't have the money to put in. And at that point, it's your problem, not their problem. We had to put a lot of extra capital in building schemes out just to protect our loan. So I do expect to see some distress in that part of the market, but I also see opportunity for better, better capitalized counterparties that will be able to come in and be able to move quickly with cash, and will have deeper liquidity, stronger banking relationships where they can acquire sites and then go to their bank or their fund and get their finance after that.
Yeah, bit of creative disruption. Andrew, question for you. So in the States, obviously government agencies like Fannie and Freddie have been lending to multifamily sponsors throughout the pandemic. Does COVID strengthen the case for a similar government guarantee lending program here? Or do you think the private sector can continue to meet the demands or needs of BTR borrowers? Appreciate we've had the VEN program, which has been successful in its own respect. But I wonder if the government's balance sheet wouldn't have been better put to use at the development end of the spectrum.
Yeah, Fannie and Freddie, they do have value-add and refurbishment products, but the main difference between the UK and the US is just there's already such a large scale of existing stock in the US. So there can be these massive Fannie and Freddie programs that have capped business quantums of 35 billion each, and then do more above that for uncapped business. And there really is insatiable demand for that. But here, I agree, the focus should really be on subsidizing the development of the product that would ideally incentivize the borrowers and the developers that are leaning toward forward fundings to use a different structure that allows the product to not get locked away in a UK institution for 30 years after it's built. So yeah, I think that would be a very popular product, and it would probably have to be high leverage and low cost for it to be more attractive than forward fundings.
You mentioned forward fundings actually, which is something I wanted to come on to. So obviously, won't have escaped your attention that most of the BTR developments, or the majority, are delivered via the forward funding route by institutions on an all cash basis. Debt hasn't really featured in a genuinely meaningful way in that structure. Do you think COVID is likely to change that situation? Or, for example, if institutions fail to raise equity right now because of the current situation, does that mean they'll be more inclined to use leverage, at least temporarily, to fill that gap? Or will it just be business as usual?
What we've seen over the last 3 months or so has been the institutions have just become more risk off and have declined more opportunities rather than looking to reduce their exposure in the capital structure for those deals. They generally are unlevered investors, and they will often bake in an internal coupon into how they structure the forward funding arrangement, so they feel like they're getting paid along the way. So yeah, I think it's more likely that they pull back and are even more selective rather than look to lever their position. We've seen in the student space, it's been a bit more common for private equity groups like Brookfield, Student Roost, who have entered into forward funding arrangements as a way to access product, but it hasn't been as common in build to rent, at least in the UK.
Yeah, if I can add, we've spent last sort of 5+ years, really trying to increase our exposure to the build-to-rent market because, we like the fundamentals of it. And one of the biggest challenges for us is finding the deals. And the reason for that is most of them are being forward funded directly by institutions at a lower funding cost than our debt. So part of me hopes that it does sort of destabilize that market a little bit. But yeah, we have more appetite, I think, than there are sort of opportunities, and we're a relatively small player compared to a Lloyds or some of the other big high street or American banks.
It's a challenge.
I just
agree, Sam.
Yeah, I just add that actually, vast majority of the build to rent lending that I've done or the team's done has in fact been forward funding because, as Mark says, that's where the sort of majority of the activity has been. So, and that's us for, effectively funding the forward funder. And I suspect that, that will very much continue because, vast majority of the cash that's coming into this sector is institutional. People are there's still a hell of a lot of cash in the system that's got to find a home at some point. And I suspect that, I don't really foresee major changes. I think the one or two things that will change from our perspective in funding some of these forward funders will be that sort of, side-by-side equity, which has been a feature of some of our transactions. I think people will look a lot harder now at that side-by-side equity and will risk, I don't think we were doing that without any guarantees, but I think there will be a real focus on, fund or corporate guarantees as far as that side-by-side component. I think the other thing is the contractual nexus. It's always been a little bit of a, pickly thing to kind of untangle the entire contractual nexus between developer, forward funder, and then the funder of the forward funder. And then you have obviously the contractor and the sort of various subcontractors. So I think there'll be a little bit more of a focus, just making sure on things like LADs, on funding of overruns, because there's often this sort of profit retention, right, which we all take a reasonable amount of comfort from in terms of delivery risk, and indeed sort of just general retention. I think there'll be a lot of focus on how risk is shared between those parties, and ultimately how risk is then allocated to lenders. So. Along with Mark, I think I'd echo what he says. I mean, we're still very keen on the sector. I think there's a lot going for it. I think the rent collection shows that, fine, there might be a little bit of cross subsidizing there from the furlough scheme, but overall, I think we're still extremely bullish about housing just generally for the many push and pull factors that I think we've gone over many a time. So yeah, look forward to seeing more transactions really. Both traditional and sort of forward funding.
I'm sure the mention of side-by-side debt and equity will be music to the ears of many of our listeners this afternoon. Since we're doing a bit of future gazing then, how do you all see the future of the BTR sector evolving from a financing standpoint? I'm going to kind of track it back to US multifamily, where obviously much more mature sector, and the market there tends to bifurcate between merchant builders on the one hand who develop the ground up assets which they then stabilize before selling to institutions for the most part, and value add investors who buy tired assets, renovate, stabilize, and then sell those to institutions typically. Both business models use leverage, including institutions are often providing the takeout. So the question is, do you think the UK will follow a similar path once the sector becomes more mature, or are these institutional, often all equity forward fundings just a feature of the market that's set to remain?
Shall I take that one?
Be my guest.
Yeah, a few thoughts there in terms of how I think the sector will evolve. I mean, one of the main things that I've noticed coming from the US and now working here is how much power the valuers have in determining loan proceeds and other aspects of the loan structure. And part of that is just the nature of how liability works here in the UK, and also just how that profession is viewed. But it's also a byproduct of there just being fewer comps and less data in the sector. There's fewer up and let properties that are proving out these top of market rents. There's fewer trades of completed stock. You kind of have to use forward fundings to triangulate yields. I mean, in the US, that you don't have that challenge. So it's a lot easier to substantiate the developer underwrites. So what we found on many of these build to rent schemes in the last 12 months, 24 months, has been the developer will assume 3% per annum rent growth. They'll assume a more aggressive yield than you can prove just because there may not have been a scheme like the one they're developing that's sold in the market. They may be underwriting higher rents that are available in the market just because there's no true comps. And they may be underwriting an SPV exit as opposed to an asset exit. And when you essentially dial back all of those assumptions, a deal that's a 25 to 30% profit on cost is now net neutral or even net negative on a red book basis. And when lenders, in addition to debt yield and loan to cost, are also constraining by LTGDV or LTNDV, so net of the purchaser's costs, then you run into situations where the developer wants 60 to 65, but the scheme only qualifies for 50 to 55. So I think that as more evidence arises, it'll be possible for valuers to underwrite some of those same assumptions that developers have been underwriting, and ultimately should lead to higher loan to costs as we emerge from the COVID crisis.
Yeah, I think I'd agree with some of that, and I think that we've certainly refinanced stabilized stock over the last 24 months. So I think we are seeing the first wave or first sort of real wave of built to rent stock that's completed, that's stabilized, and that's coming up for refi. I think the market's big enough for both models. That you described, Jonathan. I suspect, though, like student housing, my sense is that it's going to be dominated in the UK by the larger institutionals and consolidation. So I think whilst there will be some of the, what you said, build merchants coming along, building things, I think ultimately, and I suspect my sense is COVID might sort of increase kind of institutional activity, just given access of funds and debt and so on and so forth. My personal view is that I think you'll see a slightly bigger tilt towards the institutional market rather than sort of, your sort of developer X that's got one scheme. I think it's going to drive more consolidation and more of a focus on larger institutional players.
Does that mean institutions will go up the risk curve and start developing the assets themselves then?
I think that's a question mark. I think there probably will always be, some form of development partnership. It depends on what their sort of, longer term aspirations are. And we've seen some platforms doing, building up their own construction teams. I mean, in essence, it is construction management for the large part of it. It's not as though, people are sort of employing huge volumes of people to build these schemes out. So I suspect some will do that. You've seen some housing associations doing that in the build to rent space. But I think there will always be a partnership with developers. I just don't think that you will be seeing developers sort of necessarily the piecemeal developer model where someone builds something and then eventually it stabilizes and then flips it. I don't really see that working in this environment because I think capital will be pretty tough for them. It may be that there are other alternative sources of capital open to them, but they will be expensive. And in an environment where that rental growth piece around 3% or whatever that we see in most appraisals, whilst I think longer term we all expect that and hope that ends up being the case, I think in the near term it'll be tough to prove that sort of rental growth and the premium that you get versus secondhand stock.
Yeah, if I can just comment as well, I think how sort of Andrew described, where valuations come in versus client's business plan is almost like line by line, our experience of looking at new build to rent projects. And I think, the problem is, the valuers can only sort of follow the sort of red book guidelines, and there are a lack of comparables, both in terms of rents where, because added amenities and a premium product are being provided by build to rent, these aren't supported in the local market. And also potentially on what the yield is. So for me, when using the same example as Andrew, a request for a sort of 60 to 65% LTC loan gets pulled back for a 50 to 55% when you use a valuation rather than a business plan. For me, the difference between those really, the question is that risk that a bank should be taking on a sort of 3.5%, 4% sort of margin, or is that actually, because it's not proven, isn't that equity risk? And or is that preferred equity or some sort of MES risk, and should it be priced differently? I'm not saying it can't be funded, but I don't think it's right for lenders to have to lend against a business plan, as I say, at 65, which a valuation supported by comparables pulls you back to about 55. So I think that's something that's constraining certainly our thinking on some of these deals. I think also just to try and address your question about where the future is. I think a lot of people, certainly myself, think of build to rent as big towers of sort of flats of sort of 200, 350 units. What I think we might see is more of I think it was the Sigma model, where institutions, start building up houses, in more sort of rural or outside of city locations. I think, what we have learned in the last 12 weeks is, certainly in our world, we can operate outside of an office. We don't need to be at a train station that can commute us into London in 30 minutes. So if you can do your job at home, would you rather not live somewhere perhaps in the Midlands or somewhere where land is a bit cheaper, but where you can actually get a house and a study where you can conduct your sort of webinars, and maybe a garden to banish kids to?
Yeah, I'd be fascinated to hear everyone's opinions on that, because there's a lot of talk right now about that flight from, urban to suburban living as we emerge from, this crisis, and people seek that outside space that you referred to. Plus, the realization that you don't have to spend necessarily as much time in the office, ergo less commuting. I wonder, is that likely to provide more momentum to what was really kind of a nascent subsector of the BTR model? So, or suburban BTR, or garden style, as Andrew would call it. And will the lenders embrace that sector in the same way they have its kind of urban cousin or equivalent?
I think it requires scale. And I think that's probably one of the things that's been perhaps limiting. So if you look at things like PRS, REIT, or Sigma, there is real scale, right? And I think for I'm extremely bullish, by the way, on the single family model. I just think it requires a certain degree of scale before it can become kind of a true viable financing opportunity. But we will see that, no doubt. And I think COVID will accelerate that. I also, I kind of look at all of these sort of forms of or different models as sort of complementary. I think that, we need a multi-tenure strategy in this country. I think having just one type is just not going to work. And I think we've all I think we all understand that. So, and then just just to kind of come to your previous question, Jonathan, in terms of trends, I definitely see an accelerating trend towards sort of senior living BTR. I think actually what this crisis will do, and is I think the proof is in the pudding in terms of some of the sales velocity numbers and coming through from house builders and developers, is I think it will present an opportunity for, not just in the senior living space, but just generally. I think it will probably create a bit more of an opportunity for BTR. But I particularly think the senior space is quite attractive from a build to rent and PRS perspective.
Well, Andrew, what do you think? I mean, you've got quite a good insight into, kind of what Americans would call garden style. Do you think that's going to really take off here in the same way it has in the States?
Yeah, I think it'll all be based on the demand, because when we've underwritten those schemes in the past here in the UK, typically the biggest challenge is the rents that can be earned in those locations. And it's very hard when you factor in land cost, build cost, et cetera, to get to a reasonable profit on cost. At least that's been our experience. Maybe Sam and Mark have seen differently, but as the demand increases, that should push up the rents that you can underwrite for those schemes. And I think it will become more viable.
I think Andrew makes a really good point, and I think it's one that I sort of thought about to make, is this sort of no frills kind of product. And I know that we've spoken a lot about amenities in the past, et cetera, et cetera. And I think the single family for me is sort of, is quite a no frills product. And I think both in the multifamily and in the single family, I think hopefully we sort of still, whilst getting some of the more amenitized products, we do start to see the more affordable no frills product, because I think that's going to be defensive and certainly needed in a time where, there are various economic shocks that will inadvertently lead to some pressure on unemployment, etc., and wages. So very bullish on the no frills model.
Well, we're talking about single family homes now, and one of the main gatekeepers of that inventory is obviously the house builders. We've got a question from one of the listeners. Does the panel see any opportunities coming out of the house builder sector, either in terms of distress or just a desire to maintain turnover? Can they name names? Question mark. I suspect you won't be able to do that last piece, but if you could answer the first part.
Yeah, I don't think distress. I mean, depends. Most of the house builders, certainly if you look at FTSE 250 and up, right, they're well capitalized. They've got access to public and private markets. They've been accessing, some of them I know have been accessing the corporate finance facility, and generally leverage levels are pretty, down or low. Sales velocity has been impacted, and yes, as a result, I think that their entire business model is a cookie cutter model. They need to sort of sell, get cash in, and I think rather than waiting out for some of these sort of high prices, I think you will see some de-risking by way of selling entire blocks or selling certain sort of inventories to others, and that I think will be a calculated move. I think will give. We'll just bring in additional liquidity. But I'm sort of, I'm not sure that bit about stress is necessarily correct. I think there's a lot of government support. You've still got the build buy to let scheme, and you've got a lot of cash just generally in the system. So I'm not sure whether it'll lead to wholesale distress. I think these guys are well capitalized. Some of the regional smaller ones maybe, but on the whole. It should lead to some opportunities for acquisitions, I think.
You probably just disappointed a lot of listeners, but thank you for your honest opinion. Mark, you were going to say something, I think.
Yeah. I suppose I think the first thing is I don't think we're at that sort of distress stage yet. But one of the things I keeps me awake at night is just how bad the economic impact of this health crisis is going to be, and I find it really hard to just quantify that. So we could find ourselves with a number of sort of distressed assets coming onto the market. I think, and also even before in normal times that we were also seeing transactions, where house builders were selling, a number of their assets to investors. I think the thing to bear in mind is, if I was an investor, my understanding what they want, they don't want pepper potted schemes, So if you're left over with a number of flats that you haven't been able to sell in a scheme, I don't think that's attractive. I think if you can pull together a number of perhaps self-sufficient assets that an operator can sort of manage with efficiently, then I think it's got some potential. And the other thing I suppose is it not more likely that people that are going to develop out would then choose to go down the build to rent model and try to forward fund it rather than to go for a for sale model where they're likely to take that debt on their own balance sheet? So I think we could see more of that happening. Okay,
guys, I think we're coming up against the end of our session now. So thanks to Andrew, Sam, Mark for your time today. It's really great to hear your insight. Hope everybody found it useful. Thanks for all the participants. We had nearly 50 people show up, which is great, very encouraging. I'm sure we'll do more. If anyone's got any kind of hot button topics they want us to discuss, again, please let me or Dave at UKAA know, and we'll put something together again in the next kind of 2 or 3 weeks. Okay. Have a good afternoon, everybody. Thanks for your time. Take care. Speak soon.
Thank you. Bye-bye.